I am recording a little later today, episode 171 of Weekend with Indiacharts, because I tried earlier in the day and for some reason I was very sleepy, and the moment I was sitting here I was knocking out, so I said I'd rather take a nap and record this properly because there are three important questions that people have asked me to answer. The first one is for long-term investors, what should they really be looking at, thinking about? Second is, what are the takeaways from the recent event that I attended of CNBC 25 years, a lot of speakers. So I'll try to summarize my thoughts and takeaways from that at the start. And the third is, what is the dollar really doing? And there are two alternate outcomes that I will discuss. One of them I've published, and we'll look at the other one as well. So, but then both are now turning out to be bullish. One a little bullish, one much more bullish. And which one is going to be the choice is going to be a tough one. But the move may not be complete based on those thoughts. Okay, so these are the three things. So first, I've given a general outlook of the dollar. We'll look at it with charts. And the investment outlook depends a lot on whether the fall from the recent top of, 26,000, almost 300, right, 277 or something. From there, does it end in 3 waves or 5 waves? So that has been the whole quest, right? Every time it's fallen, the first impulse wave, when we got that right, I was expecting a bounce. The bounce happened in mid-caps, large, but not in so much in Nifty, and then it started to sell off. Then we saw it as a 3-wave structure, so we said, okay, ABC, and we're looking for a bounce. Then again, it bounced very little and did the same thing, repeat pattern, and this week, it broke the 4th. So last week I wrote about, if this is ABC, we can even project a last 5th wave pending to new highs happen here. The second scenario is, if it ABC, it can become a triangle, which is a multi-month consolidation pattern. Okay, so we'll look at these with the charts as well, but just to give you an idea. But the third one is the most tricky, and it looks like we are going for the third one, which is in line with the two thoughts I had spread 2 weeks ago, which is, have we completed 5 waves from March, or have we completed 5 waves from March 23 or March 2020, right? Those are the 2 points, starting points of this whole bull run. And if this fall converts into 5 waves, and we've already marked it as 1, 2, 3, 4. So why am I still saying if? If is because the 5 wave is not complete. The 5th itself so far has 3 waves, right? For some reason, if it terminates, doesn't happen, then we'll have that question mark. Although on weekly charts from Nifty 500, auto, infra, consumer, a lot of these sectors have 5-wave declines on the weekly chart. But on the daily chart, the 5th is still 1, 2, 3, 4. So we don't have the 5th or 5th yet. And on the Nifty, even the 4th or 5th is not clearly visible on the hourly chart. So what I was looking off for on Friday is a slight bounce and then sell off. Now it looks like it's going to gap down based on Gift Nifty. It can vary a bit here and there. But if we are lucky and we get that 4th bounce, 100, 200 points, still, till we don't go beyond, say, 23,800, we will be looking for that last 5th down. If we get the last 5th down and this entire fall from 26,000 to wherever it stops becomes a larger 5-wave decline, then the whole fall is now A. What we were thinking in the first leg is A or around 16th of October. Now this whole fall till the bottom in November becomes a larger A. Now when it becomes a larger A, 2 things happen. One is, we know what the next 12 months are going to be like in terms of the structure. Okay, so we look at the structure. Structure is a complex bear market that lasts for 12 months, which eventually becomes ABC x ABC x ABC, which is WXYXZ, and therefore becomes much more predictable. The bad news is, it can either be like 2015 or 2010, where it's a 1-year consolidation. You don't lose more than 20-30% from the top. Some long-term investors don't mind that kind of an index drawdown. The second scenario is, you get a deeper bear market, which we've only seen like 2008 and others, where the WXY is a huge retracement of the entire rise. Now, which of these again depends on how deflationary does the environment become, and deflationary really depends on how much financial risk develops in the system, something we are not able to point out to right at this moment, except that we know there are excesses in certain zones. But what would cause the liquidity tightening, given that the US has to keep printing money and fund its deficit? So that has been the catch-22, right? But and so this takes me to the discussions of CNBC, and the rest of whatever I've said so far will happen in charts. But you got the idea for the long-term investor once we confirm. So this week is going to be very important, confirming that the fall completes a 5-wave. And moment it does, then we have the map, and we know that it's now a larger degree something, whether and over 12 months, we know the time, 12 to 18 months, you can spread it. You know the structure, you know the direction, how it's going to go up, down, retrace, and so on. The only thing is you don't know whether the whole decline will only be a 20-30% or will it be something bigger. Even in terms of retracement, say 38% of the whole thing, or will it be more than that? And because we've seen smaller consolidation phases, like I said, 2011, 2015, we sort of have that picture also in mind. It can be like this. It doesn't always have to be a 2008 type deep bear market. And so, but yeah, definitely when you have something going on in time over 12 to 15 months, it's almost can get called a bear market of some degree. And the losses vary in different stocks depending on what went up too much without reality, and those which actually have growth and valuation manage to survive much better. So that differentiation, which has now started to happen finally after months of those extreme readings on those 1 or 2 sentiment indicators, would then play out. So all this is predicated on our getting the 5-wave decline, which means hopefully small bounce Monday, Tuesday, and then last sell off to new lows would look like a proper 5-wave decline on the Nifty, which it's already looking like on some of the weekly indices. And there also on the daily, we have seen a fourth, like auto index did close positive, I think, on Friday. That's a fourth, and then falls to a 5th new low. That would be a 5-wave decline of larger degree. So that is the setup. We are almost there, and it would confirm and push us in that picture. So what would long-term investors end up doing then? See, once you have a larger 5-wave decline A, which means B is only going to be a retracement, and that is the last exit scenario. If you're caught in wave A and you're an investor, wave B, the 50-60% retracement is the last exit before it gets worse. And hopefully in that bounce, the stocks you own bounce more. Otherwise, you won't get a much better price, but hopefully you'll get something better than where it will bottom out. I can't even say better than where it is today, because we don't know the size of that 5th also. So that is where. So if you have not managed risk based on what we said in the long short report, that is, look at the averages, and I've been saying it over weeks, based on the weekly setup, based on something, reduce exposure. Then your only case is that, okay, in the next B wave, where I'm sure that now it's fallen in 5 waves, I will exit on that retracement, whatever the level is. Now again, after that, if you don't, then there is little that, we can really say about what you should do. Because specifically for each person, yes, KYC is different. That's why I don't do advisory. Because each person is different. How he wants to manage, how much risk he's comfortable with is something I cannot know. I can only tell you this is the structure of the market and what it means and what is the last chance on point from a 12-month perspective, what we are going to go into. And we look at the Elliott wave map of what it looks like and where we are right now. Okay, so that will be an interesting look. So now let's take us to the third and most vital issue, which is post-Trump election. What is going to be the impact on our market? Now, I thought based on seasonality and classic technicals, September, October is down. After that, markets usually pick up. US market also usually goes down pre-election, goes up after election. Now, there was a very small pre-election sell-off in US this time, not the type we saw in the last 3 elections, and very late. But India did see the peak in October and sell-off, so it looked like, okay, we are following the seasonality. So which means typically we should bottom around Diwali or 4th of November when the elections happen, and the days after we should rally. Now US did that. It dipped for 2 weeks into the election and then rallied to new highs. But this week we have seen selling come back to the US. So what is really going on? And India continues to be weak. So we did not bounce at all post the Diwali lows. So this takes us back to what Trump has been saying and what is the Trump trade that has been playing out in the market. So I think from pre-election, as the market started to anticipate that Donald Trump is coming back, money started to move out of various places, some of the Asian emerging markets, and more recently we've seen it out of Europe into the US because of what he's been saying he will implement and the expectation that he is coming back. It also led to bonds falling, okay, which means yields going up and the dollar going into a rally well before the election. So the market started to anticipate this is what is going to happen. And I thought, okay, these fears are just top-sided because see, Trump, his classic style is he says a lot of things, then there are negotiations, and then he may not do exactly what he said. He'll do something, but it may not be that bad. Unfortunately, we won't know the answer to that till January. The opposite side is people saying that, see, now that he has full vote, he's not going to try and balance things. He's going to go all out. But that's very similar to what people have said when Modi came to power in 2014, and people had said, now the BJP is in full power, kal se to Hindutva chalu, and whatever they think that it means. as if the country is going into dictatorship and so on and so forth. And now we are in the third Modi regime, and nothing like that has happened, but a lot of reforms have been implemented which were pending for years. Some of the toughest ones, and still people have broadly accepted things like demonetization and all that came in between. So the outcome can be very different from the expectation. But there is one major change which I think all the big investors have started to anticipate, which is what I heard at the CNBC event, and there was a lot of discussion back and forth. So let me just take you through that. So the fears which are expressed more by, I think, a Ramesh Damani or a Uday Kotak, and then countered by others, but sort of I think they came to the same lines, but the countering is more on choice of investment. So I'll tell you how. So he's highlighted that, see, this may be a regime shift, which is something that even Ritesh Jain has been saying, I think, on my Twitter feed, and he's on his Twitter feed, and I've been retweeting sometimes. And that is that the regime shift is US really wants to move manufacturing back to the US, from other places to the US. Now, that doesn't mean they can move all of it overnight, but they want to start that movement. Now, when you start that movement, so you do it with a lot of negotiation. Okay, if we are going to continue to manufacture there, we want to sell products in your country, and if you have tariffs, that is making it uncompetitive for us, and those kind of things, negotiations are going to start. What will be the end result of all of that? We don't know. So this uncertainty will continue till he comes to office, and then he starts those measures. Initially takes some tough measures, then they go back foot. So it could be 6 months of uncertainty. So what do markets then do? They remain uncertain, right? So this fear that whatever he's doing will be a regime shift towards the US, okay, which means if manufacturing is trying to go back and we're trying to deglobalize in some way, can the old model of manufacture and export to the US really work? And therefore, you may have to come up with new models. And in fact, India might have to create products and services that are unique to itself, not just for domestic consumption, which is already there, but even for global trade. And otherwise, we are going to really lose out on the global trade side on various fronts if we try to be competitive, or else we might just get hit by various, duties and, trade barriers. So that's the complexity with which that's the risk that we really face. And similar things were said by, Uday Kotak, highlighting that, see, post-reforms, that was a thought that Indian firms have to get competitive, and then they wanted protection. So there's some level of protection. Now, some level of protection is there in every country. And that is what, Manish Chokhani was highlighting. But then the common theme was that he also said, see, we have to find and invest in new businesses that are doing local stuff that is actually good. Okay, but then that means not the whole market, right? You just can't chase the whole market, and it means you have to be stock specific. Some things might do better than others. Will cyclicals do well or not? So there is a perceived risk because earnings are not growing, and that's the only part which probably Ramdev Agrawal also agrees with. We can't see earnings visibility into next year from his research team. But of course, Ramdev is a perma invested, fully invested bull type of person. He'll only get out of a stock if he believes the company is not doing well or it's not worthy of investing. So he'll always be invested. So he's a different type of investor. Ramesh Damani, of course, is a stock specific investor, but stays for the long haul. But his understanding of global macro, other things is very good as even Manish Chokhani used to speak about it. But I think the one-way run in the market has sort of put him thinking about the long-term, same kind of argumentation that we generally see from funds, because the market's really not halted on macro issues. So he sort of set himself that fine, we just focus on picking the right stocks. So that's, I think, was his highlight. Otherwise, because India is going to grow in terms of GDP, and if you exponentiate this 6 to 8% growth over 15-20 years, we are going to be much bigger. The fourth person on the panel is, of course, CEO of NSE. So he couldn't contribute on these aspects except that NSE play a big role in the overall growth. Another pointer from Manish, which is important, is that all this growth means the India's financial sector cannot remain this small. So you have to be invested in financials. So that was a clear theme coming out. And if you know, and I've also written about it, financials are the last undervalued sector right now in the market, right? Where valuations have really come down after PSUs that did well last year. So a lot of money from funds, if you've been listening to online interviews, have actually been allocated wherever they wanted to. They're allocating to banks, and that is why banks were holding out better than others. But we did see selling in banks last week, and it looked like wave C starting, and even banking index, when I'll go to, it's done 1, 2, 3, 4, and we are waiting for the fifth of the structure. And fifth of C means still a lot of downside that can drag the Nifty. which we'll get into. Now, coming back, but eventually, even if you get this larger ABC correction in banking, that is the place where long term you still see value, and that's where a lot of money may continue to go and provide some kind of a floor. Okay, so clearly this risk has been highlighted. In fact, the other side where we say, and I say rates should come down. I would like the RBI to cut rates and long-term rates will come down. But now we are seeing these risks elevated because of Trump, that bond yields in the US may remain high because everything that he's going to do, from tariffs to protectionism, etc., are all going to be slightly inflationary. And if they are slightly inflationary, even if inflation doesn't go out of control, it limits the amount of rate cuts you can have, and there will be that rate differential between like an emerging market like India and US will be very, very narrow, and so it will become hard to cut rates. The rupee will keep weakening. So that's a risk embedded in here, that my rate cut scenario for India can get delayed by all of these things if they take time. Would you get a rate spike, as I've tried to anticipate twice before, and then it didn't happen, once in 2018, once last year when the market was weak, and then eventually I went in line with, well, yields are going down. US is cutting rates and yields in India should have gone down, but have we delayed it? That is the risk. Eventually, of course, I think they will go far, far lower than where we are right now. That will be the trigger for the next bull market. But the question is, in the interim, what is going to happen? So in the interim, and we started to see this week the second, second level of rub-off effect, which I'll come to, which is what is happening immediately. So the immediate first level effect was US going up, US stocks going up because US will do better than others, which, like I wrote today morning on Twitter, is not sustainable. But of course, we had to see it in price to believe it. But so far, that was the trade, right? So it was US rising, Bitcoin rising, dollar rising, yields rising. All four were going up together, and something had to break. Now, this week, equities have broken. The next thing which happens if equities break is somewhere bonds also get a bid when things really turn bad. But till that point, till that fear of inflation coming back doesn't go away, I don't know how that trade will play out immediately. It may play out eventually. So that delays the rate cut scenario further. And that means the dollar remains strong for a little longer. So this is going to be the risk environment for the next few months till we get clarity on the Trump trade. That is, will he be as harsh as he's saying? And he will be harsh on some things, which means this is a new reality. Earnings are not growing into next year, as highlighted by some of the panelists, which is pretty clear. And if earnings are not going to grow, then are you going to pay these valuations for those earnings? So except in few pockets of growth or companies that are going to do work that is going to become the growth model of the next 10 years, which means in areas where India can create new products and sell to the world, those are the places where you want to get invested. And if you are able to identify something like that, then that is of course something completely new. Will this model of manufacture in India and sell abroad work permanently? It's still working, it's still going on, and we are still talking of China +1 and other things. But would the measures that now Trump will take, and will they get countered by Europe in a way which also hurt us? And if the whole world goes into a trade war, then what? Is something we'll not have clarity on, and it can hurt the whole investment outlook on that theory, right? Make in India. So that is, I think, the larger risk, which is what Ramesh was trying to point out to some extent. Uday Kotak also tried to point out that Indian companies should think about becoming competitive, not just doing a price war and with protectionism. And that was the thought in 1992 when we actually started the first round of reforms. We used to say the same thing. Now over time, our companies have become this. So it's not 100% to say that Indian companies haven't gone abroad with products and stuff. But have we gained significant mind share and market share in something? Maybe not yet. And so that is the new coming that has to happen from India's side as we become a larger and larger part of the world economy. And what Manish was trying to say, then look for opportunities in that zone. There will be. And don't turn too negative. But in the broad market where a lot of valuation today we've given to these themes, they enter a dangerous trajectory. Even Donald Trump, while he is not fully supportive of the renewable energy game plan, right? So it could even hurt that part of it, but India is still supportive, so it may still be good for those sectors. So now all this complication is going to come up in thinking, is this good enough? Not, should I pay this price today? Not. And so that actually allows for the valuation correction that was long awaited to happen. Okay, and this 5-wave decline which I've been talking of will confirm it. Now what has been happening in the last 1 week on the Trump trade? US market suddenly starts selling off. Now this is following what was already a commodity decline. So see, his measures are going to be inflationary, yes. His measures will cause interest rates to remain elevated, yes. That means the dollar remains stronger for longer, yes. What does that mean for commodity cycle, which I was expecting third wave? It means it goes back into second wave and stays in second wave till a deeper retracement. It doesn't mean third is not coming, but it means that third got delayed again. And that now means it even in the metals sector for the short term till we get that confirmation of third wave from commodity prices is at risk. Okay, so I've gone back and forth on this risk also. Like I put out certain charts where I was showing metal stocks can be A, B, C, larger retracement at the start of October. Then end of the month I was like, okay, can metal still be a 4 and a 5? And again, that has not happened. They failed on that last rally. And so you go back to thinking, then is it still a B and a C? So that thought process comes now with commodities. Of course, oil has stopped falling a lot, but it has still not given a bullish clear signal. So oil remains at risk. Copper has broken its lows. The last rally is now 3 waves. Again, not good. Aluminium had an ending diagonal in a bounce. So ABC, when C has a ending diagonal, it can become a corrective rally and end. So it doesn't, and EDs don't only happen in fifth, they also happen in C, which is also an impulse, right? ABC. So it can happen at the end of any trend, corrective or impulse. And we've seen that in silver, in aluminium and so on, and they have started to reverse. So if we do get a continued correction in commodities, what we are really saying is rising dollar causing commodity prices to go down is deflation first. Now deflation first, if it gets accompanied by some kind of slowdown, which is again not visible in US economic data, because US economy is supposed to now expand a little bit into January is based on HI research. Now if that is true, then it's not immediate. Okay, but markets somewhere start anticipating when valuations are very high that the best is priced in. And that is sort of what I showed in another post, the negative divergence of reliance with valuation, right? When that happens, prices move to a new high, but valuations don't. Is it a negative divergence? And I'm first time with strike charts and historical, I'm able to observe these things. So I initially thought, okay, in some cases, was it a sign of strength that, valuations are lower, even as prices are stable? And it did give us a rally in, certain stocks that was showing that kind of pattern like Maruti, Ashok Leyland, etc. or Shriram Finance. All of them rallied on that drop in valuation. But now that those valuation divergences are still there, is it a negative? And that's what I was trying to discuss on the Reliance chart on Twitter. So main point being that that's what even in the US, you have a high valuation system set up. Your thinking growth is still there. But will the market continue to do that? And you got this ending diagonal in the Nasdaq. So on a more immediate basis, because the whole world was selling off as US was going up, eventually it's hitting the US, right? If you have deflation in commodities, you have Europe and Asia going down because of the expected policy framework. How can it be a win-win? You cannot have US win and the rest of the world lose in a globalized economy. So everybody is going to go through some pain. And that has started to show up this week, right? So now, so that won't change the trajectory of the dollar and yields. That ends up being the right part of the market. The pain ends up shifting elsewhere. Okay, and that is what started to show up this week, which is falling bonds, rising dollar, and falling equities. And that's a classic risk off. But of course, in a classic risk off, actually the classic risk off used to be rising bonds also. And that has not happened this time around yet, even though the bond prices are at the falling trend line resistance. And if they break out, then yields go higher. So what ends up happening is the other regime shift, which I had already spoken about last year, that the inverse correlation of bonds to equities has changed to a direct correlation. In other words, when yields go down, stocks go up, which is what we saw most of last year. But as yields are now starting to rise, stocks go down, right? Which means bonds and stocks fall together. So they're not inversely correlated, they're directly correlated. But there was a lead lag, right? For some time, bonds have been falling. They've affected other parts of the world sooner than the US. Now the US has also joined in. So that is what I think has happened this week. Okay, we'll see for the continuation as far as US trend. But India's trend, if that 5-wave decline happens, will become clear by this weekend. And these are the things I'm going to now go over through the chart. So I hope you got a comprehensive answer that there were a lot of risks. Yeah, one more person who highlighted certain risks I was going to, and I think deviated into this whole topic, and that was C. Rangarajan, the man who headed RBI at the time we had the great reforms in the early 90s. And what he said is that a lot of people talk about lowering rates. So that is where I went into a loop. Lowering rates and increasing demand, right? And all these interviews on YouTube, if you really want to go and see, they're all on the CNBC YouTube channel. And lowering rates and increasing demand is fine, but when you want to, lowering rates also means you want spend. So you want government to spend money, cut rates, and you want demand to pick up and people to consume. Okay, but consumption comes from savings. And if you want to invest money in the system, okay, where does that investment come from? That also comes from savings. You have to save money, then only you can invest. Okay, and you have to save money, then only you can consume. But if you over-consume, you won't have money to invest. And if you over-invest, you won't have money to consume. And so there is always a balance between consumption and investment that has to be looked at. That was what C. Rangarajan was saying. He was saying we just keep talking consumption. But we also have to talk about the saving side of the equation. Else we'll end up doing too much of one without really understanding the other. And that is how, I guess, not in his words, bubbles form, right? So that is the risk of bubbles, is always when you overdo one side of the equation and don't hit a balance. And that is where he was then applauding the RBI for having maintained that balance and taken care of that part of the risk. And so a lot of credit he was giving to Sri Shaktikant Das, who was also on the podium at that point of time, to give him an award. So that was these are all the points of the discussion that really came up. And if that is the line of thought that you want to hold back, you don't want this to become a bubble, and so we are keeping rates elevated in India, and of course inflation data has to cool off before we start cutting rates. That simply means that rate cuts only happen after a slowdown. Now US did see some slowdown and some rate cuts so far, but like I said, January you'll still see growth picking up, and that could really delay further cuts, is what the market is getting fearful of, and that is why US bond yields are also rising, apart from the Trump trade effect which is going on. So net takeaway, I've given it to you in pointers, but takeaway is this, that risk is going to remain in markets, especially equity markets, financial markets, till Jan, Feb, March, where it becomes more clear as to what the actual policies of the US under Donald Trump are going to be. Okay, and till then you can't take a clear-cut call on this, and uncertainty is going to remain elevated for most world markets. And if that is true, then you have to prepare accordingly. And if that is true, most probably in the coming week, we will get the Nifty 5-wave decline confirmation, which will set us up for a slightly longer duration correction consolidation period, which can last, say, 12 months minimum, 18 months maximum. So I would sort of be more now prepared for that. Okay, like I said, next week is just a confirmation, and hopefully after A wave, you'll get a B wave retracement where you will get that last bounce and higher prices, exit, etc. But the scenario for the next year will have permanently changed. And this is something that, Ritesh was highlighting in my podcast with him also in June, that, post this election, I hope there is a consolidation somewhere, because you don't want it to go into a bubble. India is in a sweet spot. And so this is something people have been asking for sooner than later, so that we don't go into overvaluation and bubble territory for India and just consolidate and then move higher. So hopefully it's a consolidation and move higher, which means we will not break more than 20-30% from the peak over 12 to 18 months and then head higher again. That is the ideal scenario. But unless the world goes into some kind of a reversal and the recession in the US gets worse, then that can aggravate scenarios, or you end up with stagflation or something. Those things, if they happen, they can worsen that scenario. Otherwise, this is the ideal outcome that we can start with, that you have to prepare for. And with the final confirmation coming with the 5-wave decline. So I've spent 30 minutes now, I can see, just ranting because of these inputs that some of you asked for. So let me now quickly go over them with charts. And couple of sentiment data points also coming through, which will give us that final 5th wave bottom. So we look at that as well. So I have the sentiment chart open in front of me. So maybe I should just quickly do that, because two data points are at extreme. One is the client side. Okay, it's already reached 2,90,000 plus. And previous peaks, like on election day, were around 3 lakh something. Even here in March of 23 and all, it was closer to above 3 lakhs. So we're very close to that number now, above 3 lakhs, which is where I probably have drawn this red line, is where we will have crossed this. I mean, we have already crossed this red line, so I've drawn it slightly below, but 3 lakh number has been crossed a couple of times. So let's see if we do that in the next few days. Now, FIIs were still not reaching that extreme number, but finally you can see FII shorts getting added in this fall. So if we do the final fifth wave in Nifty, which can drop us easily to 23,000, closer to 23,200 ideally, but if it breaks that, then who knows, it will extend to the election lows or not. But the FII positioning here in the fall will continue to go into the red area, which it has still not done. And we will then get the same kind of extreme excessive short positioning setup, where we can say now the market is going to bottom out for some time. Right? That we didn't have. I was anticipating maybe from here it can go back up, because see, it has happened here. You have seen this happen. You have seen it happen sometimes at interim levels. So I thought if this is ABC, we can get an X with a pull up in position, and then it will come down. So I was looking for ABC, X, ABC till we didn't break the 24,000 zone. Now that we've broken 24,000, it's become 1, 2, 3, 4 and 5 developing for Nifty. And that completely changes it. So now we have case for this going into extreme oversold territory. And after 5 now, when this will reach down here, when we'll bounce, it will be in a B wave, right? It will be when this A is complete and we are going into B, which is the retracement, where positioning will go again back up here. And then again in wave C, maybe we will again come down here. This is what is now the scenario that is developing. So this is going to now again become an important chart we'll watch for, in combination with the wave aspect, for that extreme reading that everybody is short, and now we can get a short covering rally in wave B. Okay, so I'll not look at other sentiment indicators. This is sort of sufficient now to tell us what will happen. The swing, now see, because it's a bear market, the shorter term sentiment indicators like the daily swing will sometimes fail you on oversold. See, in a bull market, every oversold reading means bottom and it would rally to a new high. But now in a bear market, see, oversold reading here, it went back to the top, just going sideways. So now it will behave like we see in a bull market, in a bear market, sorry, where extreme lower readings will have positive divergences, but on the top it will just touch and go. The opposite of what was happening on the way up. So that has started to show in the fall now, bear market behavior for shorter term sentiment indicators. So every time it reaches this top end, now you will have to be immediate careful, just like we were at the bottom, ki buy here. Now at the bottom, you don't immediately buy, you wait for that proper 5 wave decline, you wait for maybe even a positive divergence sometimes. Just like earlier, at the top we were getting negative divergences. So that reading of swing will have to be just changed on its head, which can be difficult if you're not traded the bearish side, or you don't typically do short side. It can be hard to see some pattern upside down, but that's the preparation in our mind we need. And of course, I always combine it with Elliott wave. So oversold, but till I don't get Elliott wave, I'm not ready for the next bullish move. Okay, so even here, see, it was oversold here, but here it was positive divergence. You got this bounce, but bounce ended up being too small, and thus is a fourth wave. Okay, so this is how we'll read the short-term indicators. The medium term will give us a better clarity when FIs turn excessively short, that okay, wave is ending. That's where we'll get the combination. Similarly, even in diffusion indicators, we've seen initially the 100, some of the indicators turn excessively oversold, but many of the others not. So it starts with the 20, right? 20 is now hitting oversold, bouncing, hitting. So 20 will stop working. The 50-day average one is now getting oversold. Okay. So is it sufficient? It looked like, but again, you will slowly move up the curve. Remember, I discussed the 100 a couple of weeks back. I looked at this line and I said, if this line is breaking, we are, sort of doing after 5 waves, doing exactly what we did here. Right. So after 5 waves over here also, it was like 1, 2, 3, 4, 5. And then we broke this line and then we went into a bottom end phase. So this is what has happened. This line is broken, which marks the completion of this 5. Now, is this 5 completion of this whole is where we can still debate that. We can give a 100% answer, but I would mentally be prepared for both. I've been saying that. Okay. So, because it can be, okay, because this is an expanding triangle type pattern. Sometimes it can be, 1, 2, 3, 4 and 5. It's a complete possibility. Now, within this, is this 1, 2, 3, 4 and 5th pending? Once you get a 5 wave decline, the answer is no. Till that point of time, I would have kept it open. Now I won't. Okay. So now that takes us to the last one, which is 200, and that is the only one which is not reached extreme territory. So by the end of this bear phase, possibly we will reach extreme territory on the 200 also. Number of stocks below the 200 DMA will also fall below 10% by the time the bear phase is over, or in various stages of the bear phase like W, Y and Z. Okay, so now we've looked at what to watch for major bottoms and for long-term investors, plus from a positional perspective also where the bottoms will occur and coincide with these sentiment data points. I should highlight one last sentiment data point which aligns with the idea of an important talk which took very long, and I mentioned it before, but it's worth highlighting, is this one. Because in the last two occasions, like 2018 here, okay, this indicator touched the red line and this was the top, and after that, even though Nifty went higher, mid-caps from here to here, mid-caps have fallen throughout. Okay, mid-cap indices did not make a new high after that. And 2008 was a time where both Nifty and mid-cap both topped out when we touched this red line. So this indicator was odd because it was not working. We crossed this line here. I thought maybe we are done. So you all remember that. And then here when FIs were short, I said, okay, maybe we have one more rally, and we got it. But this indicator remained here in excessive zone. So now this is a new thing we've seen, remaining in excessive zone for so long. But now that the market is breaking down, eventually I would expect this to go back to the oversold territory. Typically it takes 2 years. It doesn't happen overnight. Okay, so it takes time for this to go from top end to bottom end of the range. And it also indicates underperformance of mid-cap, small-cap segment broadly from an index point of view. Okay, there could always be randomly few stocks that do very well, but broadly at an index level, it should mean underperformance. Same thing we see even in the relative strength of mid-cap, right, where RS of mid-cap is at the top end of its ranges, just hasn't fallen. We did see some negative divergence at this top, and that is sort of playing out now. So, and lastly, the volume one has been wild. I mean, it's been at the top end only, not come down. I don't know how this will eventually work out. Okay, because at the top in the market, this volume put call has not gone to the bottom end of the range as it did here and in previous occasions. It's just remained elevated. So maybe we'll get a new range for volume PCR. I'll have to give it time. This indicator cannot be read into right now. And that's it. So these are the few indicator talks. Now let's look at the structure. Now, when you look at this, you'll understand why I've been saying the mental map is very, very clear. Okay, this is the mental map, okay, of what is going to happen. And I've been through at least 3-4 bear markets now, and each one were predictable in the same way, whether it's 2008, whether it's 2015, 11, 12, all of them had the same pattern. COVID is the odd guy out, but in that also the mid-cap indices had the same pattern. The Nifty did something different for the first time by diverging and forming an ED. But this is what we are seeing now, right? So if we get this first 5-wave decline, so now let's understand this. This is the A leg. Okay, where are we right now? We have just done this and we've started this. Okay, and we've sort of broken this low, and within this fall, we are in 1, 2, 3, 4. So that's why I'm still saying let us get a full 5. Once we get a full 5, whatever that level is, where we complete A, we always get B. B is usually a 3-wave. So this is where we are right now. Here, this is where we are in this whole structure. Okay, from here to here, which either will be 30% or more decline or retracement from the top, that we don't know. But this will be the structure over 12 months or more. Okay, where there's a 5-wave fall A, B, then there's another 5-wave fall C. When we get ABC, we mark it as W. Okay, so it becomes the first ABC is considered W, and then there's an X. Now I'm giving you an Elliott wave school for those who don't understand it. Then we get another ABC, very similar. A is 5 waves down, 3 waves up, 5 waves down. Okay, so ABC is nothing but 535, and then we call this Y. After that, we get another 535, which we call as Z. Okay, this is how a bear market, a complex bear market, which lasts over time, unfolds every time. And that is why I said it becomes predictable, because once you get this perfect 5, you do get this B wave. Remember, people will say, yeah, you were looking for that B bounce over here and it was very small, it didn't happen. But it does. So that's the reason it didn't happen is it was not B, it was 2, right, which we only know now. Then some people say, then how do we know in advance? Sometimes we do. Sometimes when we are able to perfectly count the last 5 up, we do look for this bigger 5 down. But reason why it doesn't happen with us sometimes is because for so long people have been bearish waiting for this to happen. You stop expecting कि अरे होगा कि नहीं, and so therefore you don't start with the expectation कि बड़ा 5 wave down बनेगा. Okay, and that is why you keep looking for that retracement. But now it's happened. Now that it's happened, that's part of the past. the predictability becomes very high, because whenever, now that this is not one, this was one, not A. When A happens, you do get a B 50-60% retracement. You get a C which is almost equal to A, sometimes larger. That is where we have given, these are the Fibonacci ratios, typical. Okay. And then you get an X wave after that. X waves don't always do 61%. They sometimes just do 50. But B waves do have a tendency of doing 61. Okay. Retracement of A. So see, having this map, I know it's going to be 5, 3, 5, then ABC 3 in a bigger X, then again 5, 3, 5. These bigger X's often go up till the upper Bollinger Band or above the 40-week average. And the others stay below that in larger ABC declines, and so on and so forth. Okay. In a big bear market, the only thing which happens, like 2008, is Y becomes very large. 2011 and 15, where that is not the case, Y doesn't become large and the entire fall ends up being inside a falling channel. So what do we mean by falling channel? Let me just see if I can draw a line to choose what I want over here. Yeah. So a falling channel means that this whole fall ends up being inside a line. Okay, so wait, let me choose a different color. Okay, it's yellowish. Let me make it purplish. Yeah, so this is the first line and this is the second line. So whole thing remains inside a falling channel, WX, YXZ. But 2008, Y would have become very large, so you won't get a channel. That's the only difference in larger bear markets and consolidation bear markets. Okay, which don't fall that much. But they still fall for a 12-month plus period. So this is what we should be ready for. Now, where are the, so we can look at examples of this. Okay, you got the mental map. This is what we'll keep looking for. This retracement, 5 wave down, another retracement on X, 5 wave down, again B wave, 5 wave down. We'll just go on with that. Sometimes this X wave can become a triangle. Sometimes this X wave can remain a simple ABC. So that also creates confusion in the last stage of this setup. Okay, sometimes Z gets truncated, which means it doesn't make a new low, instead it forms an ending diagonal over here or something like that. Those are variations to the whole structure. But we know that we are in Z, so Z can either be an ED or a zigzag, one of the two. Okay. Okay, this is the map. You can come back and look at it again and again now that I've shown you. Okay, and then we start looking at examples of the same. Okay, so from 2000 I've been looking at examples of this. This is one complex bear market over here. Okay, it's remained inside a channel even though it was a huge 80% retracement of the fall. There were sharp retracements. Okay, this 2008. The Y leg here is this one, which is very large, and so it breaks out down from this falling channel. And then what I am referring to, what has happened since we are in a new regime, since the options became big part of the market, we don't see this kind of a sharp volatility and sell-off. Okay, don't see lower circuits and all that. But we do see deep declines slowly and consistently. So then we got these type of bear markets. Except for COVID, we got something like this, where it falls for 12 to 18 months in a nice downward channel. Okay, and that then ends up being a retracement of the last 5-wave advance. So this is the first likely outcome, most likely outcome maybe, that we should prepare for. And so in this, usually a retracement is there. So in this case, you almost retrace 50% of the rise. Unlike this 2009 where it was 78%. So it won't be that bad. And sometimes it may not even be 50%. Okay. Or it can be like this is 61% retracement of the rise. But in percentage terms, the fall was not more than 30%, 28%, 27% from the top, whereas this was almost 60, 70% from the top. So a lot of difference. It's twice as big in size. Okay. So if we do that kind of a retracement, now let us just take into account, and let's presume it's only of the last 5-wave advance here. Okay. Then it can be a very, very narrow kind of market, where your worst case after 12 months is also not below 20,500. If we say that, okay, no, it's not this, and it's of this entire rise, okay, and we do a 50% like we did in 2011-12, then we do talk of around 17,000 something at a 50%. 61% would then end up testing the 2022 lows also. That is like the worst scenario that you could have. So that is what, but again, I am not sure which one it will go to. I can only say that the structure I can try to prepare you for is something like this once we have a 5-wave decline next week. Yeah, this is what we will prepare for, not the size, scale and depth. Okay, and that is why that's where stock specific management of what you're looking at, where you can see 5 waves up on quarterly charts in stocks, Okay, I'm saying quarterly, really long term, where you can see this kind of a thing and it's turning down for the quarter. These stocks can go into long consolidation phases like this. So to give you one more zoomed up look at it, let's just zoom into this. What we are really talking of is, this is A, this is B, this is C, and then this is X. And we are somewhere here, okay, at the start of A. Which will bottom out, and then you'll get your B, then you'll get your C. This is where what we're going to be doing. And it's going to continue like that. Another A, another B, another C, another X. In the last ABC. Right? The very simple format. Okay. The only variation in a 2008 is the Y becoming very large, as we just saw. So it breaks down from the channel. And sometimes, as I also discussed, Z getting truncated. In these scenarios, usually there's that chance because Y became so big. You have W, you have X, you have a Y. Then X and then Z becomes the last ABC is truncated, meaning it doesn't make a new low, but at least reaches 61% of this last bounce. That's all you can end up doing. So I hope the investor side has an idea on this. And so let's address the last part of the question, which is the dollar index. This is a slightly tough one. So what I ended up doing to make it a little easier is actually look at the euro. See, I did post a chart of the dollar index where I've projected to 124 possibility if it goes into a larger up phase. Okay. But, you know, when you've already had a multi-month up move or decline in certain currencies, whether it's the British pound, whether it's the euro. Okay, let's take it on a white chart and just tell you. And these are all similar complex patterns, right? WX, YXZ, ABC, XABC, what I just showed you. The same thing has happened on this currency like the euro for the last, decade or so. Then usually at this bottom, you have ended something. Same thing has happened with the USD GBP also. The British pound, it's touch the lower end the third time. Usually the third time is where you end Z. So it's W, X, Y, X and Z. So typically after that, this should be 1 and 2. The only problem happening here is maybe we're anticipating 2 too soon and it's not done enough. So now we go back to this chart and we say, I was thinking 2 is done over here and 3 will start. Instead, it is now falling again. So probably we shouldn't be overly bullish on the dollar, but still we'll be bullish till the point that the euro falls in wave 2 to a deeper retracement. So this is my answer. So possibly this is A, B, and now we are inside C. Okay, B ends here. So we actually just done 1 and 2 and we are in 3 now. So 3 is going on, there'll be a 4th, there'll be a 5th. And when we complete this 5, we will have completed a larger ABC for the dollar, euro and so on. Okay, so this is a euro, opposite will be dollar on the way up. And then we will start that actual third wave along with the next wave of the commodity bull market. So this is what has happened versus expecting here in A only that, okay, the commodity bull market will start because this was looking like a triangle. I thought it broke out and now it has failed. Right, this low is also broken. So now you cannot say this is wave 1 and 2. It's not. So this is the change. Okay, so rather than look for 124 on dollar index, I'll give you a level, but basically we'll be looking for retracements. On euro, if I do this, 61% is at around this, 1.04. So that is a level we'll be looking slightly below, maybe 1.0405 was this. So this should be a slightly lower number. What is this? It's not showing up because it's hiding behind. Sorry, 1.0199. So 1.02 is 61% on the euro. So that is the major level we can look at. And are we done 5 waves till there? If not, then we'll have to go to 78%. Okay, so till we don't complete 5 waves in C, we are not done. So this is the clarity I got from euro thinking, because I do feel this is a major low is already done, in the euro, or when I look at the British pound, because very interesting channel touch points were there in these indices, and that is why I had considered that it is done. So let us just see GBP also and to get an idea why I'm saying that. Okay, and I'll show it to you on a white background. That this entire, all these lows from here to here are almost, this last one is almost on this bottom. Okay, so this is one long complex phase of WX, YX, Z is how I see it. So if you have done 3 touch points on a trend line, okay, 3 touch points meaning this and this. We have done W, X, Y, X and Z. The third touch point is Z. then we should be in recovery mode. Now, I'm not saying it can't be X and Z, something pending and etc. all that. Okay, we can always come up with a scenario, but it's not ideal. The ideal is Z ke baad we are done. So it should be wave 2 only. Somehow 3 didn't start and we are still in 2 is the best logical thought. In this case, B is gone higher. You can say expanded flat. Okay, but come up with the same key, it will be a wave 2. But expanded flat means C5 is a long 5-wave decline which can go a long way down before we go up again. And that is the change, and that is what the Trump trade will cause. So now let's bring these ideas to the dollar index itself. What would happen here? So DXY, I use the NYC contract because it has more history. Okay, there was some erraticness, and so when we see this channel, here I marked Z and I said mostly on the dollar index Z is done. Okay, rather than look at monthly RMI and trade setup, which will make me excessively bullish, which is why I projected 124. Instead, let me just go by this channel theory that Z is done. Now see, the only thing within channel theory where in dollar index, what I can argue, because we almost touch this line, I'm saying Z is over. The only bullish argument is that this is A, this is B, okay, and we still do C of Z before it's over. That is the only way it can go to a 120 kind number. Okay, but otherwise if Z is done, okay, if this high, the last touch point is Z, which is what I initially thought, then all we are looking at is a deep retracement. So if this is A, this is B, and this C is going on, and we are in 3 of C only right now, then 61% is here. For the dollar index, how much is it? It's at around 109. Okay, and if I do 78%, so let me just add that as well as a additional retracement line, then we end up at around 111.5. So these become 2 levels, and if I go to a daily chart, what I see is exactly what I have mentioned on the euro. And remember, there was an ending diagonal here, which is why it probably marked the end point of this move. But I thought, okay, initially it should only be a retracement. End can be of even wave C. But now we will take it as 1 and 2 and 3 is going on. So 3 is going on, 3 will end, there will be a 4 and a 5, and then only we will complete this move. So note, in both of my bullish scenarios, okay, even if I, let's say if I do say 120 ho sakta hai, even then it's going to be impulse. So basically from the low that we've made in September, we are looking for an impulse. Whether that impulse is only a retracement in terms of C of 2, or whether it's a impulse, which means it's a larger A, B, C of a ending pattern, both cases it is impulse. So till we don't complete 5 waves, we are not done here on the dollar index. So that makes it easier for us to stay with the rising dollar. And when it completes 5 waves up, then we turn bearish on the dollar and get our next move on the upside. So in the interim, we are still in a commodity bear market. So that takes us back. Of course, in the meantime, gold has been a super bull market, but the other commodities have not played out. They all remain in wave 2 of their respective bear markets. So let us just quickly now look at the commodity setup. Starting with the Bloomberg Commodity Index. Then after all this, I'll come back to Bank Nifty and then US markets. Before we close, I think I should cover that. Okay, so this I've been trying to say 2 is done here. Possibly it goes to 61%, possibly it goes lower. I don't know. We'll have to keep thinking now of it not being over somehow. Okay, so something will still be going on in the commodity index. It didn't touch 61%, so initially I can say 61% is my next level, but now I don't know whether 61 will hold or will it go to 78. Because as long as the dollar is rising, it's going to cause a cut in this. And a cut in this often depends on energy. Now, so far oil is not forming, but for a long time people have questioned this larger head and shoulders pattern in oil. Okay, so if we consider the larger HNS in oil, then what? So I was trying to say 5 and this wave 2 is done here. Then I'm trying to say wave 2 is done here. But what if it is not done? What if this HNS here, this head and shoulders pattern does play out and we go get a much deeper cut in oil all the way down to a $45? Then we have a scenario that will cause the Bloomberg Commodity Index also to fall more. And so far, every rise in oil has ended up being 3 waves. So we don't have an impulse. We're just trying to fit it. This is also 3 waves up. It's just not broken this interim low of 69.91. Once it does, it will confirm that we are going to new lows in oil. Okay, so until then you can argue 1-2, but it's overlapped and it's 3 waves. So the risk is more that it will break down and continue the downward trajectory. So that is what oil is doing. It's just been slower than the other, so it has delayed that eventuality. But I think it looks like it sold off yesterday. I didn't see the final take. Yeah, it sold off yesterday after holding for 2 days. So it's possibly started the next move down, which copper is already in. So I've already written about copper. Even there, the structure and counts, I think everywhere are now going to change. They're not going to remain what I earlier thought. Okay. So I earlier thought this is 61% within 2. Now see, copper has gone all the way up here. Can it come back down here to this 61% level and make a double bottom? That's back to $3.2. I wonder. If you go into a rising dollar environment continues, you're going into deflation first. That's what oil $45 means and a copper back to 3.2 means. Deflation first and then inflation again. What would that mean for gold and silver? I know some of you are waiting for gold and silver every day. And I should take the long-term chart. So I have saved some long-term charts here which I put in the long-short report. Okay, on the long-term chart, we actually in the 5th, right? And actually if I take this, see, there are different ways to count this. If I go to a quarterly chart, it is 1, 2, 3, 4, 5. That is why I maintained this 5. We didn't touch this equality to this, but we have still done significantly in terms of exceeding 1 or getting to this channel. So there's a chance if I actually take this 4 here, then this last 5 wave can end a 5 over here. Because this rise is also 3. So can it be a complex pattern X and Z into 4 over here? Just because we didn't make a new low in 4, we have taken it as maybe 1, 2, 1, 2. But if I do Z here, then we've completed 5 of a much larger time horizon in from here to here. This 5 we've completed in gold. Now I hope that's not true. Okay, it might still be my earlier views true that this correction in gold will only be a correction of this last 5 wave rise, just like we are saying for Nifty. Okay, and then after that it will continue and we'll just mark this as 1 and 2 of something, or 3 and 4 as I had just marked. Maybe. Okay, but we have completed 5 waves from this bottom, okay, in 23, and that 5 wave is anyway going to correct. So that much at least is due. And basically as long as dollar is rising, that's what will happen. So this is what we are looking for in gold. Some correction of this last 5 wave up. Will this entire larger 5 also get corrected? It sounds doubtful if we still have a bigger bull coming. Okay, to get a larger second wave in gold would be unusual, but not impossible. This is a market. This is a market, right? Anything can happen. We just know we are completing 5 and it is visible at various degrees. Now one way you can do it is go to a quarterly chart, but it will take time to confirm. If I go to a monthly or a quarterly chart, will I get a negative close at the highest level? Then I can say, okay, larger 5 is complete. Monthly we've already looked at. Okay, so I'm going to a quarterly chart. Quarterly chart, see, I can say this is 1, 2, 3, 4. What I can't say is this 1 of 5, 2 of 5, 3 of 5, 4 of 5. Then 5 of 5 is pending. That's where the confusion is. And on a yearly chart, it will look like it is an entire 5th. You're in the 5th. But again, we can't say whether 5th is extending. So don't be too negative on gold. I know, because what happens is in currency terms, gold goes up when rupee also weakens, and then it goes up when dollar weakens. So that way, for Indians, gold has been a win-win. It never gives deep retracement. And therefore, being too bearish on gold in rupee terms in any way doesn't make sense. And since there's 5th, but 5ths are always large, so I can't say 5th is large, therefore it won't be second and all that. Also, I can't say. So let's just leave it at that. That we can see what we can see on gold. Perfect 5 wave decline. Did it close positive yesterday? Will we get our first gold bounce? Again, we didn't. I am waiting every day for this 5th wave positive. 1, 2, 3, 4 and 5 is going on. And this is the risk with Nifty also. We think 5 will complete at 5 equal to 1, and what if it extends? Until it doesn't stop and give us that positive, we don't have the completion point and it's still extending. Only when it completes 5 down, then we can say, okay, now it will retrace 50%. I wrote a note on that. It's still not happened. We didn't get a positive close. But we've broken this last channel. So 5 wave to ho gaya. The last 5 ho gaya. Okay. Uska to retracement chalu hai. So even if I say 4th wave of lower degree, which means we are going to around 20 to 80. That much is certain. More than that is not certain, but that much is certain. So 20 to 80, tak, so you should be prepared. Now in silver, what does that mean? Silver, people have asked me about the ending diagonal and all of that. Those questions have come up. So let us address that as well. See, silver for long we've been trying to start a third wave. Like mar gaye hum log karte karte. In fact, initially I thought with gold, silver will have bottomed out here and done wave 1 and 2. What happened in COVID? Gold didn't make a new low, silver did. So the count of gold and silver also changed. So you had an intermarket divergence. Then we marked this as 1 and this as 2. Okay. Then I said maybe this is a complex pattern. I marked this as 2. Now I have gone beyond this. I'm hoping that third has started. But I ended up with an ending diagonal. So what does it do? And this ending diagonal which I'm talking of, because the internals are 3, 3 and it overlapped over here. Okay. What I was trying to explain to some people, can it be ABC of a rise? Okay. So ABC meaning what? Let us make this a little more complex. A, B, C. Okay, this becomes an X wave here because this is all corrective, corrective, corrective. And then there's another A, B, C. Now, at a very large degree, if I say that the entire rise is corrective and possibly has not gone beyond 138% of this, what I'm really saying is that it's an expanded flat. Okay, so is it within 123? This is a very important level. Then we'll get a marker for silver as to what it means. And I know this is not exactly the nice thing that I'm trying to say, but actually it's gone till 138. I was wondering if it did go that far. Exactly 138. Okay. Now what is 138% retracement? 138% happens when you're forming an expanded flat, which means this is A and this whole rise to 138% is B. Okay. And I'm saying this only because of this ending diagonal explanation. Now it can happen that this is just such a corrective phase going on and then it goes up again. Okay, because gold is only going to retrace the last 5. Then maybe silver only retraces this last rally and then goes up again. Okay, that is the more bullish scenario. The scenario I am painting here is that if this is a bigger B and you'll do a bigger C in silver and then come back up. Now that would be completely wild. But if we do see a 5-wave decline in silver, which we are seeing right now, we should be prepared either way, because a 5-wave decline, so it's still not like with gold, it's still not looking 5 yet. One more leg down would possibly do it. So let us just look at the daily chart, because I think we are trying to form 9 waves, depending on where you complete. If I complete this as a E of ending 3 waves here, then from here it is 1, 2, 3, 4, 5, 6, 7, 8, 9, and we did close positive. So if this low holds, we have a 5-wave decline. And then if we do a retracement in silver, we will get our first retracement of a 5-wave decline. And then possibly fall again. Now, if that happens, if we do see that this fall is 5 waves and you do a retracement and start falling again, then I have to think whether this can become a larger expanded flat and go back to a $17 and $16, which would be crazy. But I don't know. I think at least prepare for, just like in gold's case, prepare for a retracement of this last rise, wherein 61% means retest of this low. So this much at least can happen ki this 5-wave fall is A, you will do B and C. So ABC will at least get you back to around 26. Okay. Then at 26, we can rethink where are we on the dollar index and will this fall more? Because after all, commodities are and precious metals are inversely correlated to the dollar. Okay. So that thing will get clarified when we complete 5 waves on the dollar, then possibly we are not going to fall more on all of this. And depending on the structure, we will choose the best available structure at that point of time. Right now, you can only be mentally prepared for different scenarios. The minimum scenario being $26. The worst case, highly deflationary scenario is when you get to 17. Otherwise, you don't. That means world going into deflation or another recession, bear market. That is the scenario where you go back to 17. Otherwise, you don't. Right? So, that's the preparation that we need to make in our mind. Let's start with 26, and then by then we'll get more clarity on the dollar itself, where it is in the cycle. Okay, so I've given now a lot of input on dollar commodities. That takes us back to what is happening, one interesting pattern and setup we are seeing in banking. Where Bank Nifty itself can give us some kind of a confirmation of what is going on. Okay, in the very short term, as I'm looking for 4 and 5 in Nifty, there are a couple of indices which close positive on Friday, including Bank Nifty, maybe Auto Index or some of the other indices. So there on the daily chart, you can see 1, 2, 3, 4. But of course, in Auto Index, it's a 5-wave decline. Here it is A, B and C, 5-wave and C. Whereas in Autos, it is the first 5-wave decline. So this is 1, 2, 3, 4 happening, going on or complete. If you break these lows and we start 5 down, then we are really talking of C of 5. What does that mean? That means 48,300 or something, where A and C, which is this and this, will be equal to each other. And that doesn't even rule out that C can be extended. Right now, we are just seeing equality, we end up at 48,300. If it extends to this low, then you end up at whatever that was, 46,000. So once wave C starts, but this will also confirm. Okay, I don't think if a Bank Nifty breaks the low and is heading towards 48,300, then Nifty is also starting wave 5 down and heading to some other number apart from 23,200. So that opens up a lot of things. In fact, last week also in media and in our conversations here, I said if this line breaks, which was at around 50,500, then it will be Bank Nifty joining the sell-off and we see much lower levels. That was the starting point of my discussion. Now that has happened, we are looking for confirming that it does develop into a 5-wave decline and somehow doesn't truncate here and fool us. And once it does break the low and confirms a 5-wave decline, then we are looking at much lower levels. So further things that will happen. Okay. But unlike Nifty and various sector indices where this fall is the first 5-wave from the top, in Bank Nifty it is ABC. This 5-wave will be C, so it will do a larger X. So now there's going to be a slightly different wave count from Bank Nifty to other indices anyway. And that may again fit the cause that people want to buy banks, like the investor community. Because of the lower valuation and long-term India growth story, पैसा किधर जाएगा, सब कुछ से निकाल के defensive banking will become the defensive sector of this bear market. That is what it sounds like. So it will bounce more and attract more funds on the way down. Okay, just a thought. I mean, I could be wrong, but right now I'm just extrapolating my thoughts. But so that is banking. And what other chart did I really get nervous about, and that's possibly the Nasdaq. So let us just see the Nasdaq charts this week, because the Nasdaq, unlike the other two indices, actually has an overlapping structure. Okay, now what do we mean by overlapping structure? So see on this white, sorry, I have so many charts open now. See on this Nasdaq chart, I've tried to mark it. It's not on a wide background. That can this be, from 2001 onwards. You had the first bear market was 2008. Then you had this 3-4. Although in some markets we mark 3-4 year only. But anyway, the point is from 2022 low, we could be in 1, 2, 3, 4, 1, 2, 3, 4, 5 or A, B, C, D, E or something like that. And this last part was looking like an ending diagonal. So let's just go to the white chart and zoom in a little more on that. Okay, and possibly this is a composite index. Looks slightly, is it the composite index? It says IXIC. Yeah, so it is a composite index. So it goes, has slight variation, but does it overlap? I think not. So here this and this is not overlap, but when we actually take the Nasdaq 100, okay, so let me even take that for context. I don't know which of the two has more stocks. I sometimes forget it. I feel the 100 has more, but you can check and correct me. Okay, in the 100, I think that this last part did overlap. Yeah, this high and this low did overlap. So why that is important to me is that when I'm trying to draw an ending pattern over here, okay, then you get an overlapping pattern. Whereas in S&P and Dow Jones, you don't have an overlapping pattern. That's the only difference. Now let us just take a momentum chart, okay, for the Nasdaq. What has happened is after the E, the daily has gone into sell. So you have 1, 2, 3, 4, 5 on the RMI and EBCDE here. On the weekly, there was a divergence and then it took it out. So I'm just wanting to check because I have not looked at all the charts in the morning. No, we did not get a sell signal again on the RMI on weekly after this tick up. Now in terms of count, when I look at this chart, so I'm going to take a blank one and just put wave counts on it. Okay, same wave count. I'm going to just highlight what we are thinking, that if we start with a 1 and a 2 over here and a 3 and a 4 over here, and then we are trying to say this is 5, either I count it as 1, 2, 3, 4, 5 or ABCD. In this case, because of this spike low, it overlaps. And if I think this as the last leg, it's starting to look like an ED. So, but early days, you want a little more confirmation from weekly momentum and whatever, that this is ending. So then I would say that this entire structure that has happened from year to year is ABCD, some kind of a larger distributive setup, right? So after that, I would say A, and we've been trying to do that. It's just not happened yet. B, C, D. I was trying to think E here, but now this E can be pushed to this top where we have a throwover and now failure. And for this to play out, it has to break the lower line. Weekly RMI goes into sell, will be further confirmation. Then if we can get a 5-wave decline on the daily chart of US, a further confirmation that, yeah, finally we are done with this 5-wave up on US. Again, we can start with a less bearish bias that ये 5-wave का retracement होके फिर तेजी होएगा. That is the less. And all this goes against the idea of the election cycle where markets go down before election and up after election. We're trying to think here that it's going to fall after the election, and all this because of the measures that Trump has been promising, which first scared the rest of the world. But in the last few days, we are seeing the US also get scared because what hurts everyone hurts the US. I guess that's what I am thinking. I don't know if Monday this pattern will change. And once again, we'll be saying buy US, sell everybody. But so far, the sell-off of the last 3 days makes me feel that, yeah, this breakout failed over here and resulted in this still remaining an ending diagonal. And therefore, we have completed something at this stage. That's my basic bottom line. There are a few different ways we can possibly count this to complete 5, but we can stick with this one. Let me see if the monthly or quarterly give me some further judgment on that. Okay, and then we'll be done with most of today's discussion. So in the monthly, say this 1, 2, 3, 4, 5, 6, 7, 8, 9 hai, but the last part of the 5-wave is overlapping. That is what we are trying to say is ABCD. And that is the only way it can end, otherwise not. And on a quarterly chart, it's still 1, 2, and 3. So quarterly chart will say, nahi, this is just a short-term correction. US is going to continue to go higher. And after all, like I said, GDP projections for US are to grow in January. So why should the US market fall that much? So it's possible that it's only a short-term correction and impacts other parts of the world more. But just that the look of this ABCD has me on caution for the US. Also because we've been watching that steepening of the yield curve theory for very, very long. It is still steepening. And in fact, even the liquidity index has still been, rising. So if you want, we can very, very quickly look at some of those indicators as well. So here's the yield curve, went above 0 over here. At first time created some fear and then again markets went up. Now it's been flat after turning positive above 0. Okay, it's been flat. But as it keeps advancing here, usually after going above 0, markets top out sooner or later. What was history? Okay, so if I go to a weekly chart, you can see that history. I've marked all the steepening cycles. Like see, with this steepening happened in 94, that was the least bearish outcome. Let me move my image here. So this was the least bearish outcome where it fell 15-20% or something like that and then went up. Severe bear markets were only the ones here, 2000 and 2008, where it went down a lot after the steepening. But here the top had already occurred slightly before. Here the top occurred slightly after. So that's again, it's not a timing tool. It's just an indicative tool. So here also in the current scenario, we have seen inversion. See, this was COVID, right? It touched 0, started to go up. It hardly inverted. But it still rallied one last time before selling off. So there was this time between the final outcome. So same way we've seen some time right now. It's steepened here. Market has still gone up a bit. But the question is, will it follow the same pattern that eventually it rolls over into a recession? Will that really happen? There are still the recession hawks out there saying this will happen. And I've tried to go both ways based on my bond market theory. But my bond market theory was that if bond yields go down, then equities get saved. And right now bond yields are going up, which is not a good sign. So that is the killer. And if I look at the bond yield chart, okay, and we can do that in a separate box here. The bond yield chart is still trying to break out of this falling trend line of the last ABC. So I was trying to say this is X, which is why I was not too bullish on the dollar and the yields will turn down and the RMI was bearish with negative divergences. The fear is now that what if this doesn't happen? I mean, if US market is falling, there could be a small yield dip. But will it really break out of this? If it breaks out of this range, let's say it goes above 61% retracement, which is above 4.47%. So let's say a closing above 4.5 and sustaining above 4.5 would be very, very negative sign. If that doesn't happen, there's still hope. Okay, but the opposite theory is that once US stock market starts falling on recession, bond yields go down and interest rates get cut. So there's that opposite part. So it's been the struggle, but I was thinking that rates getting cut are more inflation falling theory. But a lot of headwinds coming in with the Trump thing and other things which are, mixing, creating a nice mixture out of everything and leaving us confused that which macro aspect is really working out. The only thing we can say is bond yields rising is not good for anybody. And the US is hanging on to that simply because its growth rates are higher than other parts of the world. So, but beyond a point, even they will not be able to sustain on higher interest rates. So we are at a tipping point, whereas bond yield is concerned, the dollar index is already broken out in advance, and the Nifty is about to confirm a 5-wave decline bear market, but we can't see or get that kind of a confirmation very soon from US indices because it's early days yet. So see, this is the Dow. This here also, these two possibly don't overlap. Okay, this high and this bottom. So the only way to mark it will be a proper 1, 2, 3, 4, 5. You just see, doesn't overlap. Yeah, no, it doesn't overlap. So instead of taking it as corrective, we would have to take 1, 2, 3, 4, 5. But the point is 5-wave complete here? Is this the end of the fifth in this expanding pattern? Because 5 is not even equal to, I think, this wave 1, which is pretty big. So it would be a truncated 5-wave if it ends up ending over there. So that's the only reason we would not want to think US is done. But let's see, you never know. It was a rapid trade after the US election. Now we are correcting, and next few days we'll get that clarity. But if India sees 5 waves down, India will still do what it has to do, irrespective of world market. So that is why that will be an important signal. Do we get 5 down on Nifty in the next week? Fine. I think that's sort of covered everything that I would want to really talk about, and in light of what I've heard. But the main thing is confirmation, right? I want to see that 5-wave decline in Nifty. It looks like it's happening. It looks like it's going to happen. The dollar breakout is already unnerving, which will change even my USD INR outlook if it goes up further, because I've been trying to draw an ending diagonal, and the alternate is to take it as a running triangle fourth and start a 5th wave from the recent low and mark this rise as 1, 2, 3 instead of ABC of E. To put it in very short without a chart, since we already long into this discussion today. And therefore, I'll write about it if the USD INR breaks out higher, that it's turning bullish. And that would be another sign that this rising dollar would be the bigger issue. Bond yields are at the verge of that breakout point, which can then become an issue. And US equities are still to confirm. So Indian equities will confirm for the 5-wave fall first, is what it looks like. And of course, we have seen, we don't see 5-wave decline in Europe, but we are seeing European markets and various markets also pretty weak on various time frames. If I just put it, this is a daily chart of DAX. It's flip-flopping in this whole range over here. I don't know if it will really break down. But did the weekly RMI give a sell signal? That's the bigger question. Possibly still not. Okay, not for DAX, but done for CAC, done for FTSE. Okay, so putting the chart back, the FTSE is continuously breaking levels that I'm trying to draw at the bottom as a support. And the RMI has been selling, but it's gone to 0. CAC is anyway below 0. So it's giving a fresh sell signal. See, this rise was 3 waves. This fall looks like 5 waves on the weekly. Okay, so after this last 5 up, you have a 5 down, which is I've marked as 1 and 2. So here it's a little more clear that it's 5 down, 3 up. And if that's true, we are starting another 5 down, then CAC should go down a lot. But we are not seeing the same in a DAX or a FTSE. So a lot of variation across Europe. So I'm not able to confirm whether those are similar. And so in Asia. In Asia, we've seen a lot of weakness now in some markets. Not everything is a clear 5 down. Maybe in Korea, maybe somewhere, but not everywhere. But they are breaking levels. And then that takes me back to thinking, is the emerging market index EEM only done a wave 2 or B in this bounce of the last 2 years? Because it's hardly retraced, not even 50% of the previous fall. 2022 fall has not been retraced. And now if you go into another leg down, it will be a major bear phase for emerging markets from an EEM index perspective. So that is also tricky. But yeah, India seems to be the one giving the clearest 5-wave at this point of time. And that is the market that concerns us most. And that's what we should remain focused on. And naturally, the rising dollar affects the entire emerging market space. So that's what we'll continue to face till that headwind goes away. And like I said, that headwind remains till Jan, Feb, March. I don't know how long till Donald Trump comes in, takes measures, does some attacks and counterattacks. Till that point of time, uncertainty around policy at a global level will remain, and therefore it's going to keep markets under pressure at various degrees. And so it looks like we are going to get this 5 in structure. Next week we'll be talking about, hopefully be talking about the end of wave A and the start of wave B, but we are not there yet. Okay, we are still looking for 5th of A, minor 4, minor 5, last leg development. And there also we don't know whether it will be a normal 4-5 end within 23,200, or will 5 also extend and we'll be again extending counts on that. That part again, we'll only know in real time. That's all. Thank you for me. A long video, but I hope it's given that clarity and also created enough confusion. For some people who will say, अरे यार बट ये नहीं बोला है, but dollar कुछ भी हो सकता है. नहीं बोल रहा हूँ, but बोल रहा हूँ कि dollar ऊपर जाएगा. It's not done on the move. And so the risks are still there for several months to come, and we will trade it as per ABC x ABC on our market. That is what I've highlighted. So it's pretty clear. It's not unclear. It's also clear that the commodity correction is not over. So commodities remain in a bear market. US markets have to only confirm. That is the odd guy out. In any case, we are not correlating with them. So we have to watch what is happening in our own market, not in what is happening in theirs. But if they also eventually join in, then slowly all world markets align to the bear side. Right now it's been India, then slowly Asia, then parts of Europe. Then it'll become everybody if this goes on the way it is going. Right. Thank you and see you all next time.